Good afternoon, everyone, and welcome to TBR's webinar, Disruptive Technologies and Consumer Focus Drive Innovation and Transformation in Healthcare IT, with TBR Senior Analyst John Caucis. I'm Justin Surgent, and I'm hosting today's session. The healthcare IT services market continues to expand. It's expected to be a $66 billion opportunity by 2020. Technology vendors serving healthcare organizations are under pressure to provide solutions that enhance operational efficiency, lower costs, and improve interoperability while concurrently embracing emerging technologies and delivering innovation. Insights from today's presentation are from our Healthcare IT Services Benchmark Report. If you'd like to learn more about this report, please reach out to myself or John after the presentation. And before we begin the presentation, there are a few housekeeping items I'd like to cover. First, we'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others we've posted. Second, we'd like to hear your thoughts and opinions on the material we're presenting today. Please send any questions to the Q&A function, and we will address them at the end of the webinar. And finally, we'll send out these slides for today's webinar to everyone within 24 hours of the conclusion of the webinar, along with the recording link. You can also find these slides as well as our previous webinars and thought leadership pieces on SlideShare at slideshare.net/TBR_market_insight. Now let me introduce the analyst presenting today. As a senior analyst in TBR's professional service practice, John Caucis provides client-specific research and analysis, including primary and secondary research for specialized programs. John is also the lead author of TBR's Healthcare IT Services Benchmark Report. And with that, let me hand this over to John.
Thanks, Justin. And hello, everyone, and welcome to TBR's Healthcare IT Services Benchmark Review for the fourth calendar quarter benchmark of 2014. As Justin mentioned, my name is John Caucis, Senior Analyst and Manager of TBR's Public Sector and Health IT Services Research Practice here at TBR, and I will be the presenter for today's session. I've been an analyst with TBR since 2001 and have directed the Public Sector and Health IT Research Program since 2008. A few notes about that program are our focus within the health IT services market specifically is to provide company-centric research to accelerate our customer success. The information we will be reviewing today comes primarily from our Health IT Services Vendor Benchmark Report for the fourth calendar quarter of 2014, hereafter referred to as 4Q14. This detailed report includes information on vendor strategies, strategic actions, key developments during the quarter, as well as alliance and acquisition activity, and overall fiscal and business line performance for the vendors that we track. The information our Health IT Services team delivers is valuable to any vendor looking to expand their footprint or to compete more effectively in the global healthcare IT services market. So we're excited to present the findings from this most recent of our Healthcare IT Services Benchmark reports, and we look forward to receiving your feedback and responding to your questions about the information presented today. And with that, let's begin on page 4. So today we'll discuss three primary topic areas from our most recent Healthcare IT Services Benchmark study. We'll cover some of the key financial highlights from the fourth quarter benchmark report, which published in April. We'll move then to discuss how the companies in our benchmark study have responded to the market environment within their operations, within their portfolios, within their offerings, as well as how they have leveraged partnerships and acquisitions. And then finally, we'll conclude with the outlook for the remainder of 2015 and take your questions. So beginning on, or I should say moving to page 5. We'll spend the next few minutes reviewing some of the key financial metrics from the most recent Healthcare IT Services Benchmark study and how the conditions in the current health IT services environment impacted vendor fiscal performance. And in particular, we're going to focus on trends in revenue growth and profitability and discuss the drivers behind the vendors that emerged as the leaders in this most recent benchmark report, in leaders in terms of growth and profitability. What we've observed, in a nutshell, what we've observed throughout 2014 as well as into the first part of 2015 is that the pace of EHR implementations has decelerated despite demand remaining in place for compliance-ready solutions that are cloud-based and secure across all healthcare segments. And this is illustrated on the following slide. And I'll take a moment to orient you to the graphic here on this page. The blue line in the graphic represents the average total year-to-year growth for all 20 firms in our healthcare IT services benchmark study. The red line also represents average year-to-year revenue growth, but we calculate this on a trailing 12-month basis for the benchmark companies in order to smooth out the impact of seasonal events and other types of seasonality. Both of the averages are weighted to account for the size of each benchmark company's respective revenue base in healthcare IT services. So what we observed during the course of 2014 was a continued deceleration. This deceleration continued into the fourth calendar quarter of 2014, and we saw this with both growth rates that we are illustrated here. The impact of two recent strategic level acquisitions, that being Cognizant's purchase of TriZetto and Cerner's acquisition of Siemens Health Services, will not have the full impact on our growth calculations until the first calendar quarter of 2015, which the benchmark report for that quarter will be coming out within a few weeks. Now, as the average growth rate for the companies in our healthcare IT services benchmark has decelerated since late 2013, in fact, although this deceleration has taken place, our research is showing that this growth rate continues to exceed that of the global IT services market, which in our most recent global IT services benchmark report was estimated at about 1.3% on a trailing 12-month basis. The volume of EHR implementations and EHR-related projects diminished during the course of 2014, and we attribute this to many large healthcare providers and provider organizations completing or ramping down the installation of new HR systems following the establishment of incentive programs in 2011, for example, by the Centers for Medicaid and Medicare Services. But despite the deceleration in growth that we observed throughout 2014, the market remains buoyed by demand for healthcare information exchange projects, interoperability projects, as well as increased demand for outsourced solutions. So due to the aforementioned deceleration in the EHR market, we observed that the average weighted year-to-year growth fell about 130 basis points in 4Q14. And we see this attributed primarily to generally fewer greenfield opportunities, as the majority of large provider organizations have already implemented EHR platforms. We believe that these provider organizations are now increasingly focusing on cutting IT costs, leveraging IT to reduce operational expenditures and reduce their overall expense profile. And as they themselves face increasing budget pressures and other profitability challenges, which is in turn resulting in the provider organizations increasingly consolidating their vendor relationships and adopting more affordable IT solutions. In terms of vendors, we see vendors such as IBM, CSC, Dell, HP, and Cerner benefiting from this vendor simplification trend and the increasing focus on affordable solutions. We see these vendors being well-positioned due to their scale and the scale of not only their delivery capabilities, but also their portfolio, enabling them to offer a broader range of affordable solutions and provide more comprehensive end-to-end IT solutions for provider organizations. So with that, we'll shift gears to review how the contractors in the benchmark study are performing relative to one another in terms of the size of their healthcare IT services revenue base, revenue growth, and profitability. So I'll take a moment to orient the audience to the graphic on this page. This is an illustration of the 20 firms in the quarterly healthcare IT services benchmark study and how they position against one another in terms of top-line growth, margin performance, as well as the respective size of their revenue base in healthcare IT services. We've also called out on the graph which companies are growing the fastest and which are doing so most profitably, and that's essentially the key takeaway for this illustration. And we'll call out the drivers for the margin leaders in just a moment. The x-axis on the graphic represents the absolute dollar growth of each company's healthcare IT services business, while the y-axis represents the reported or estimated operating margin for each vendor's healthcare IT services business. And finally, the size of the bubble represents the volume of revenue generated during the quarter through healthcare IT services sales. So the average year-to-year growth rate for the 20 firms in our benchmark study on a trailing 12-month basis of 5.4%, we've plotted this with the vertical dashed red line here, while the average trailing 12-month operating margin of 13.4% is plotted with the horizontal dashed red line. And we have also highlighted the growth in margin leaders, as I mentioned on the graphic. And I'd like to shift into talking about the drivers behind their performance. The growth leaders, the top 4 growth leaders during the fourth calendar quarter of 2014 in rank order were Cognizant, Cerner, Deloitte, and Accenture. Cognizant is beginning to realize the inorganic revenue impact from the TriZetto acquisition, and the company did report adding several new logos to its healthcare practice following the announcement of the TriZetto acquisition last September. Believing that the acquisition had piqued interest from its clients in platform-based solutions that will leverage the now increasingly consolidated capabilities of both companies. Cognizant is also realizing success mining new business within its newly acquired client base and leveraging cross-selling opportunities by offering clients complementary BPO as well as consulting services that will help them extract more value from their TriZetto solutions. And we believe that Cognizant's cross-selling effort will continue to gain traction and produce more meaningful results in 2015, but may take some time to really accelerate as Cognizant engages in new relationship building. We anticipate that Cognizant will focus increasing on integration work around TriZetto's platforms, especially within its own base of healthcare payer clients, in order to drive short-term growth during the latter part of 2015, especially. Moving to Cerner, Cerner continues to leverage the EHR core of its business and is expanding its portfolio through the introduction of new capabilities, including predictive analytics, population health management, and IT hosting services. We also have observed Cerner leveraging its own extensive EHR install base to cross-sell new capabilities such as IT hosting, which its clients are increasingly demanding to their need for secure cloud-based IT environments that enable them to reduce costs and manage their risk profile. Deloitte's leading growth in 4Q14 owes primarily to its continued successful leveraging of its vertically focused consulting-led approach in the healthcare as well as in other vertical markets. We see Deloitte applying this methodology to drive higher value engagements that increasingly incorporate now elements of analytics, EHR, and population health management. And to accommodate the growth that Deloitte is realizing in healthcare IT services, Deloitte also aggressively accelerated its recruiting efforts around healthcare throughout 2014 to bolster its expertise in technology-enabled consulting solutions. We also see Deloitte enjoying the benefits of the approximately $150 million to $200 million investment that it made in its Converge Health business line about a year or so ago, while it has also added capabilities for private health exchanges to the cloud mix solution within Deloitte Digital. And we see this enabling Deloitte to capture new consulting-led awards in IT transformation, as well as in the adoption of emerging technologies for healthcare payer, as well as provider clients. And then finally, Accenture was another one of the growth leaders, leading growth vendors in 4Q14, as its top-line expansion was supported in large measure by the extension of the Center for Medicaid and Medicare Services contract, as well as other contracts outside the U.S. with government agencies in Spain and India. Accenture also continues to gain traction with its offerings in connected health clinical services as well as healthcare back office, and is capitalizing on its foothold in the state government healthcare space in the U.S. And we will actually have additional commentary and analysis on Accenture in a few minutes as we take a more competitor-specific deep dive into some of the vendors in our benchmark study. Finally, I'd like to make some final comments about the operating margin leaders during the quarter, and these in rank order were Infosys, HCL Technologies, CPSI, and Epic. Infosys continues to add new proprietary solutions to its healthcare portfolio, such as the recently launched healthcare platforms Clinical Trial Supply Management and Osteoporosis Solutions. Infosys continued to earmark budgetary outlays this past quarter for R&D and continued hunting for potential acquisition candidates that will add new healthcare solutions around higher margin analytics, automation, and cloud solutions. Infosys also continues to leverage its global delivery model to offer clients more price competitive healthcare solutions that is in turn enabling it to generate above average margin performance relative to its peers. HCL Technologies also leverages automation to improve the efficiency of its IT outsourcing and business process outsourcing solutions for healthcare clients, enabling it to reduce the labor intensity of its services and in turn reduce costs for its clients. HC's longstanding just-in-time hiring model is also being leveraged to control expenses and sustain employee utilization. Similar to Infosys, we see HCL increasing R&D outlays and looking to make acquisitions of smaller companies offering higher margin healthcare specific solutions as it continues its march up the value chain. CPSI was another one of our margin leaders during the quarter, owing to the improvement that it has made steadily throughout 2014 with its margins as it gains traction in higher margin EHR and physician application solutions. CPSI's internal and expense control efforts and the ongoing margin improvement with its TruBridge subsidiary buoyed its margin performance and actually enabled the company to announce a 12% increase in its quarterly dividend during the quarter. CPSI is also increasingly bundling revenue collection management offerings from TruBridge with its software offerings, and this is serving to further enhance the profitability of its engagement. Epic's margin performance continues to be essentially underpinned by its expanding suite of analytics, hosting, consulting, and managed services offerings, which often command premium pricing in the market. And this is further supported by its profitability, I should say, is further supported by its fairly highly tuned project delivery mechanism. So with that, we'll move on to the next page where we detail some of the healthcare IT services trends we observed during the quarter with respect to geographic markets. The core geographic market for the majority of vendors in our benchmark, our healthcare IT services benchmark, remains the U.S., though TBR has observed a deceleration in growth across all the geographies in 4Q14. Once again, owing primarily to the maturing market for EHR platforms and the associated services with the EHR platforms. The IT spending profile of healthcare organizations, we believe, is also shifting as the EHR market matures across the globe, especially in the U.S. and in North America. Healthcare organizations in the Americas continue shifting their focus to leveraging IT to reduce operational costs, which is in turn resulting in smaller contract sizes and pricing pressure on vendors. In response, we've observed the healthcare IT services vendors in our benchmark in the Americas and in North America in general, increasingly in making investments to expand their portfolio of analytics, population health management, and revenue cycle management solutions, and going to market with an increased emphasis on these service areas. In Europe, we observed a similar deceleration in growth across most of the European market due to some pullback in public sector spending in healthcare and more challenging economic conditions in select country markets. However, the maturity of the market in EMEA is lagging slightly behind the Americas, certainly in the less developed countries in the region, where we believe the more robust growth is taking place. And this is especially the case, we believe, in the Middle East, where population growth and petrol wealth-driven affluence, along with the growth in mobility, solutions are helping to sustain revenue growth in healthcare IT services to a greater extent than in the Americas. We also see in Europe that while many healthcare organizations are already well along the EHR adoption path, others, once again, primarily those in less developed or less mature markets, others have yet to embark on their own EHR journeys, sustaining somewhat more robust demand for EHR implementations and related work than we've observed recently in the Americas region. In Asia Pacific, growth in the APAC market continues to trail other regions as the market is less mature than the Americas and EMEA. And we've seen this reflected in the more limited penetration of technology primarily into the provider segment within APAC, and the continued heavy reliance on paper-based administrative systems throughout the region. This limited penetration of health insurers into Asian markets has also restrained growth in payer-related IT spend, while payer organizations are also continuing to struggle with interoperability issues. The early implementers of healthcare IT solutions in this region faced higher internal integration and subsequent maintenance costs, which served as an early disincentive to IT investment, but we see these deterrents diminishing as we move into 2015. So as a result, we see the growth in the Asian healthcare IT services market accelerating in 2015 and especially in 2016 due to the continued maturation of large economies like China and India, where investments continue to be robust in overall IT infrastructure and healthcare IT infrastructure to accommodate growing populations, especially growing middle-class populations. The burgeoning medical tourism industry, especially in the APAC region, we expect to be another major driver of growth in the region's healthcare IT services market in 2015 and beyond, as well as the need across the region for more integrated and interoperable systems, not just for payer organizations, but for provider organizations as well. So with that, I'd like to shift to the second discussion area today, where we'll do a bit of a deeper dive into vendor activity to align with the conditions and demand trends in the market environment. And in particular, we'll summarize key developments regarding new solution introductions and new alliance formations. We've observed throughout 2014, and this continued in the fourth calendar quarter of 2014, increasing R&D outlays among the healthcare IT services vendors that we track. We've seen vendors across the board, in fact, making investments to drive new solution introductions in areas primarily analytics, cloud mobility, and interoperability. A few examples on this slide, beginning with Cerner. Cerner noted that during the course of, the latter part of 2014, that in 2015, it expects to spend about $650 million on R&D, with a particular focus on interoperability, analytics, and mobility solutions. We do see this increased spend enabling Cerner to expand its portfolio and better compete with other large global end-to-end providers such as IBM. The growing R&D spend that Cerner plans to make will also position the company to keep pace with pure-play competitors such as NextGen, CPSI, and Allscripts. And finally, Cerner has noted that it very clearly intends to leverage the acquisition of Siemens health services, and the scale gained with the acquisition to plow even more capital into its R&D efforts. Infosys CEO Sika has and continues to emphasize the development of proprietary IP and solutions across all of its verticals, and including healthcare. And Infosys also further ramped up spending on R&D in 2015 to add new healthcare solutions around analytics, automation, and cloud. Primarily well, I should say, in addition to expanding its portfolio as another lever that Infosys has traditionally pulled to drive higher margins in its operations, as these solutions tend to generate higher margins than Infosys' more traditional BPO and ITO offerings. Allscripts has invested over $500 million in R&D as well as in acquisition since 2013 to drive the introduction of new solutions, including its Care Director, Population Health Analytics, and Sunrise Surgical Care solutions. And this has in turn enabled Allscripts to increase the proportion of add-on sales in its revenue base throughout 2014. However, this has come at a cost, as Allscripts has been one of the margin laggards in our benchmark study, as we illustrated a few moments ago in one of the earlier slides. And as a result of its own $200 million commitment to R&D back in 2013, as well as stemming from the acquisition of pharma BPO vendor Octagon Research Solutions a year earlier, Accenture during the quarter launched its Life Sciences Cloud for R&D in collaboration in Oracle, and Oracle will be the data center host for this solution. This platform, we believe, will help healthcare clients enhance the efficiency of their own R&D function, increase speed to market for new products, and improve overall patient engagement. And in tandem with the platform, Accenture and pharmaceutical companies, including Merck and Pfizer, joined together under the Life Sciences Cloud Coalition, which the organization of which is aimed at incorporating digital technology more into R&D and drug development while maintaining quality and reducing costs. So with that, I'd like to move on to some notable alliance activity that we witnessed during the fourth calendar quarter of 2014, beginning with Allscripts, who in collaboration with Express Scripts rolled out the Allscripts e-authorization solution, which essentially enables physicians to conduct prior authorization electronically when writing prescriptions. We see this system as enabling clients to reduce cost, time, and the labor intensiveness of the prior authorization process, including earlier decisions for prior authorization approval or denials. We believe this solution will also further bolster Allscripts' portfolio by adding capabilities that increase cost savings for clients by reducing errors and improving patient outcomes for its clients. In collaboration with Airstrip, Apple, and CSC, IBM expanded its mobility solutions offerings. With Airstrip, IBM is co-developing a mobile acute care early warning system, for example, that will employ its real-time analytics software. And then with IBM and CSC, as I mentioned, IBM continued to expand and enhance and deepen its partnerships, in particular around mobile applications. And then finally, NextGen and Merge Healthcare partnered to integrate their respective interoperability platforms. The Merge iConnect network allows customers to send and receive electronic imaging reports, while we see NextGen's Share platform opening up communication channels between providers, allowing for more secure data sharing across the continuum of care. And we believe that this collaboration will improve NextGen's customer value proposition due to the continuing growth of its solution offerings that the Share platform is interoperable with, which we believe is in turn crucial for clients looking to enhance the interoperability of their own systems in order to meet meaningful use Stage 3 standards. Our final topic area today will be on the growth outlook for the next 12 to 24 months with the firms in our Healthcare IT Services benchmark study. We expect, in a nutshell, we expect EHR replacement, cybersecurity, predictive analytics, and revenue cycle management will be among the key drivers of growth for healthcare IT services vendors over the next year or two. So let me take a moment to quickly orient you to the graphic on this page. And what we've done here is something similar to the illustration earlier in the deck, with the blue line representing the average total year-to-year growth for all 20 firms in our Healthcare IT Services benchmark study, with the average also weighted to account for the size of each company's respective revenue base. We've captured data from 2014 and provided our projections for the next 4 quarters, taking us through the end of 2015. And we've also plotted our estimates for average growth, excluding the inorganic impact of the two major strategic acquisitions made recently, those being Cognizant's purchase of TriZetto and Cerner's purchase of Siemens Health Services, using the red line on the chart. So following the deceleration in average growth rates that we observed throughout 2014, we believe that the market, in fact, will bottom out has bottomed out in the 4th calendar quarter of 2014, and we see a modest acceleration in the pace of organic growth in 2015, with a significant inorganic boost to growth being provided by the 2 aforementioned acquisitions. Absent the inorganic impact of these transactions and these acquisitions, we believe that the slice of the healthcare IT landscape that we track would actually see a much more modest uptick in growth, but an acceleration nonetheless. Additional trends that we've observed and where we see the vendors in our benchmark study going over the next year or two, we've seen vendors including IBM, Xerox, Cerner, and Allscripts, as I mentioned earlier, continue to increase R&D outlays around next-generation health IT solutions, around cloud, analytics, security, and mobility. And we don't see this decreasing. In fact, we see this continuing to accelerate during the course of 2015 and 16. We see predictive analytics with IBM to note as one of the leaders in our healthcare IT services benchmark study within the predictive analytics space due to its extensive investment in R&D and acquisitions, as well as companies like Accenture and Xerox, although they're having to play catch-up a bit as they increase their own R&D spending and pursue analytics acquisitions and new alliances to enhance their own analytics offerings. Vendors such as CPSI have chosen the partnership route to enhance their portfolio and their solutions in these areas. CPSI formed an alliance with IBM recently to jointly develop predictive analytics. And we see some of the smaller pure-play vendors such as NextGen and India-centric ventures such as Infosys continuing to pursue a partner-led predictive analytics development strategy due to the lower development costs associated with that. The EHR replacement market is a space, a sector, a trend that we observed really emerging during the latter half of 2014, and we see during the course of 2015 the vendors in our benchmark more aggressively pursuing this market, more aggressively pursuing EHR replacement opportunities by engaging with their client bases to initially gauge interest in switching EHR vendors and eventually to help them make those transitions. We believe that the EHR replacement market is worth several $1 billion as it is saturated with over 400 EHR vendors currently, many of whom are small and unable to make the R&D outlays necessary to move their platforms to meaningful use 2 or 3 compliance. We do believe that the replacement opportunities will take some time to materialize fully, as most providers will retain their current EHR vendors until it is clear that they will not be able to make the upcoming, meet the upcoming meaningful use 2 or 3 standards because of the considerable time and investments required to make the switch. But we do see this increasing. We do see vendors accelerating their efforts in EHR replacement throughout the course of 2015 and 2016. Finally, revenue cycle management continues to be an emerging growth opportunity for the vendors in our benchmark as ICD-10 adds complexity to medical coding and billing, and this is in turn prompting provider organizations to increasingly outsource this function to the vendors in our benchmark. RCM, revenue cycle management, is also becoming more important due to more stringent government reimbursement rates and the increased frequency of out-of-pocket payments. Analysts have estimated that physicians lose 25 to as much as 30% of revenue from improper billing under ICD-9, I should say, and with the emergence of ICD-10, that number is set to rise. We see vendors including NextGen and McKesson as being well positioned to increase their own market share due to their current breadth of their RCM offerings, as well as successful track records of boosting revenue for their clients. So with that concludes the bulk of our presentation for today, and we're happy to take your questions at this time.
All right, so if you have any questions, please send them to the Q&A function, and we'll get started with what we've received so far. So first question, what do you think the impact of the CSC split will be on the health IT services market or otherwise? And will it affect CSC's chances on the federal DIMSM award?
Okay, thanks for the question. That's a very, very good question, especially in light of the big splash that CSC made in the global IT services market with the announcement of its split. We see the separation as being a necessary for CSC to do, and we believe it will enable both of the new companies, the commercially focused as well as the public sector focused entity, to go forward ultimately with greater agility, and they'll both be freed from the kind of internal operational and organizational entanglements that have been inherent in operating two multi-billion-dollar business groups focused on essentially very different vertical markets. We see similarities to the separation that Booz Allen Hamilton undertook back in 2009, and we think that the split. We expect the split. In fact, we've already observed that the separation is generating a fair degree of uncertainty in the marketplace, especially within the CSC's NPS group, its North American Public Services group, and its federal client base. We've also observed most recently competitors in the federal market, such as Leidos and others, forming internal exploratory committees, if you will, to examine the possibility of targeting NPS's current roster of federal clients and capitalizing on the ambiguity that's swirling around the separation of CSC. And now with the separation on the horizon, I believe the target date for completion is October 25th, which is also, in our view, a very aggressive time frame for such a split of this magnitude. We have to wonder if IT decision makers in the federal market are themselves wondering if there will be disruptions to existing service levels on existing programs within CSC NPS. We don't have any indication of that currently, but certainly the questions are probably being asked. There may be some impact on CSC's alliance network, with partners wondering if the split will disrupt their own ongoing collaborations with CSC. CSC has recently formed or expanded longstanding relationships with EMC, VMware, Cisco, Microsoft as well, IBM, Amazon Web Services, AT&T, to name a few. And we wonder if clients will wonder if they will still have access. Clients on both sides will wonder if the access to those partners that they've enjoyed through CSC will in some way, shape, or form be interrupted by the split. Specifically in relation to the upcoming DIMSM award, there may be more uncertainty around the prospects for the CSC HP Allscripts team on the upcoming DIMSM award, especially now with two of the team members about to undergo major separations in their operations. As I mentioned, CSC plans to complete its separation by the end of October, and I believe HP's target date for its separation is November 1st. And we believe that this may have enhanced the chances for the other teams, the IBM-led team and the Accenture-led team, as the clients in the federal space, you'll wonder about the potential impact of the separation of both CSC and HP.
All right, next question. What do you think the impact will be of the two strategic acquisitions you mentioned, being Cognizant and TriZetto and Cerner and Siemens?
Thanks for the question. I believe that the TriZetto acquisition has been essentially complete since the end of 2014, and I believe that Cognizant did report some minor revenue accretion to its top line during the fourth calendar quarter of 2014. It's interesting that Cognizant has elected to continue to run the business as a standalone unit within its healthcare practice. And it predicted, I believe, that about $1.5 or so billion of revenue opportunities from the combination of its capabilities with TriZetto over the next 5 years will be realized. But it qualified that by saying that it expects the bulk of the revenue to be more back-end loaded during this period of time, primarily coming from large integrated deals that will take more time to case and to close. In the near term, we expect Cognizant will focus more on the integration work around TriZetto's platforms, as we mentioned earlier, within its existing base of payer clients. We also see Cognizant continuing to build relationships with TriZetto's clients with the objective of eventually cross-selling more BPO, consulting, and IT outsourcing solutions. With respect to Cerner and Siemens, we see the acquisition giving Cerner much greater access to a broader client base and creating many more cross-selling opportunities for Cerner to cross-sell its analytics, population health management, and IT hosting solutions. Cerner does aim to port Siemens EHR clients over to its own EHR platform, which will enable it to consolidate its own EHR portfolio and reduce the inherent complexities. We see the increased scale also enabling Cerner to be more aggressive with its pricing, being able to spread costs across a larger client base. And while I expect Cerner will leverage and continue to effectively leverage an internal shared services model to generate greater synergies, it will increasingly do so as it integrates Siemens into its operations. And then finally, the scale that Cerner will obtain with the Siemens acquisition, and they've been very clear about this, it will enable them to earmark more budgetary dollars for R&D to generate solutions, new solutions in automation, artificial intelligence, and analytics.
All right, I think we only have one last question here. On your earlier chart, you discussed the drivers behind the growth and margin leaders. What about the laggard companies?
Yeah, thanks for the question. A common theme that we observed among the growth laggards, in particular firms like Leidos, Harris, and General Dynamics, CGI as well, was their high level of exposure to public sector related healthcare IT spending, which, especially at the U.S. federal level, has been somewhat hampered by the budgetary turmoil in the U.S. federal market. Within our benchmark study, we noted that public sector healthcare IT services growth was actually below that of other markets. Looking at a few figures from our benchmark report, the federal and state, I should say federal growth was about 1.3% according to our benchmark, whilst the state and local space grew about less than 1% respectively. Compared to the other healthcare sectors that we track, for example, life sciences, where growth was just under or just above 4.5%, and just over 7% for the payer and provider segments, respectively. Despite being laggards in our benchmark, though, we do see CGI and Leidos improving their positioning. CGI is getting traction in the UK healthcare market, and Leidos will continue to restructure its own healthcare business to refocus on its core federal healthcare business. And certainly, if Leidos is on the winning team for DHMSM, that will help Leidos to improve its revenue and its margin profile as well. The clear margin laggard in the quarter was Allscripts, and as I mentioned earlier, this is due primarily to its very aggressive focus on R&D investments, which it is doing in an effort to accelerate its own top-line growth in 2015. We do see this happening, although its margin performance may continue to lag throughout at least the first half of 2015.
All right, well, that's all we have for questions. We're going to go ahead and end the presentation. So thank you, John. Thank you, everyone, for your questions. You can follow John and TBR on the Twitter handles listed here. And additionally, please check out our SlideShare and YouTube pages as well. And one other thing, we will be following up with everybody via email with the link for today's recording and the slides tomorrow afternoon. Additionally, before you sign off, I'd like to ask you to take a brief survey about today's presentation. We're always looking on how to improve the information we provide and how we provide it. The feedback would be greatly appreciated. Otherwise, we'll leave the chat function open for another minute or so for folks to ask last-minute questions, and have a great afternoon. Thanks.